Welcome to the deep dive. It really feels like the ground is constantly shifting under businesses these days, doesn't it?
It really does. Think back maybe 10, 15 years ago, business cycles felt, well, slower, more predictable maybe.
Exactly. Those long stretches seem to have just vanished. Now everything feels accelerated.
Totally. And it's driven by this potent mix of things.
Hmm.
Technology obviously leaping ahead.
Right. And how we as consumers behave keeps changing too. Plus, you've got supply chains reconfiguring and
Yeah.
global events constantly throwing curveballs. It's a lot.
It is. So we're not just talking about small tweaks, are we? This is more like fundamental reshaping of whole industries.
Absolutely. And to really get a grip on it, we need to go beyond just saying things are changing. We need to look at the how and the why.
And that's exactly what we're going to do today. We've got some fascinating insights pulled from a recent newsletter, looking at some really significant disruptions happening right now.
The idea is to unpack these changes, see the mechanics behind them, so you can get a clearer view of, well, what's going on, and maybe even what might be coming next.
Yeah, looking at specific examples really helps illuminate the bigger picture. We can start seeing patterns.
Definitely. So today we're focusing on a few key areas from the sources. First up, quick commerce, how that's shaking up traditional retail.
Right. Then we'll get into electric vehicles. Big one.
Huge. And how they're disrupting the whole internal combustion engine world.
And finally, something a bit different, lab-grown diamonds and the pressure they're putting on the natural diamond market.
Sounds like a plan. Let's dive in.
Okay, let's start with quick commerce, or QC. Particularly in India, the growth has been, well, pretty remarkable.
How remarkable are we talking?
We're talking reaching a $4 billion gross order value GOV in just about 4 years.
Wow, 4 billion in 4 years. From like a standing start.
Pretty much. That
Yeah.
kind of speed is exceptional.
Okay, so what's fueling that? It feels like a fundamental change in what people expect.
It absolutely is. Instant gratification is becoming the baseline, hasn't it?
Yeah.
People want groceries, daily items, maybe snacks delivered super fast.
We're talking 10 to 30 minutes. That's the new standard.
That seems to be the benchmark these platforms are setting. And think about what that does to loyalty.
Yeah, if you can get something similar now, why wait for your usual brand? Speed trumps loyalty sometimes.
That's a key point. Convenience, specifically speed, is reshaping how people buy. We're seeing more frequent purchases, too.
Right, smaller baskets, but ordering more often instead of the big weekly shop.
Exactly. And the platforms everyone's talking about, Blinkit, Zepto, Instamart, they've really nailed this need.
It feels like it's moved beyond just, oh no, I forgot the milk. It's becoming more of a routine, right?
The data suggests that, yeah, order frequency is up. Even average order values, the AOVs, are creeping up. It's becoming habitual.
But let's put that $4 billion in perspective. How big is the total market they're playing in?
Well, the total addressable market in India is estimated at around $63 billion. So $4 billion is about 6% market share currently.
Only 6%. Okay,
Yeah.
so still massive room to grow, but already disruptive. What's the risk for the old school shops?
Huge risk if they don't adapt. That 6% might seem small now, but the projections, they're talking a 36% compound annual growth rate.
36% CAGR.
Wow, which could take QC to maybe $25 billion by the fiscal year ending 2030. That's FY30E. So yeah, the potential is enormous.
Yeah.
Traditional players could lose serious ground.
Now, the question everyone asks with these super fast delivery models is, can they actually make money? The unit economics.
That was the big question mark initially, definitely.
Yeah.
But it looks like they are figuring it out. Take Blinkit, for example. They've massively increased their dark store network.
Dark stores meaning those local fulfillment centers, right? Not actual shops.
Exactly. They went from about 385 in FY23 to over 1,300 projected for FY25.
Yeah.
That's a huge build-out.
And that must help with delivery times and reach.
Absolutely. Denser network, faster delivery. But it's not just stores. They're getting smarter about what they stock, focusing on popular items, maybe higher margin stuff, and optimizing deliveries, better routes, packing more orders into each trip, order density, plus cutting back on discounts, using hyperlocal logistics more efficiently. It all adds up.
And I guess being part of a bigger company helps, like Blinkit being owned by Zomato. Does that make getting customers cheaper?
Oh, definitely. Massive synergy there. They can cross-promote, share marketing, tap into Zomato's existing user base. It brings down that customer acquisition cost, which is crucial.
Right, makes the whole model more sustainable long term.
Precisely.
The newsletter actually has some visuals on this, right? Exhibit 1 showing how retail in India has evolved.
Yeah, puts QC in context. And Exhibits 2 and 3 show Blinkett's GOV growth and that dark store expansion visually. Helps to see the trend lines.
Okay. Very clear picture on quick commerce. Let's switch tracks now. Electric vehicles, EVs.
Right. Another massive disruption underway in India. And it's not just cars, it's across the board. Two-wheelers, three-wheelers, buses.
The growth sounds pretty dramatic there, too.
It is. EV penetration has nearly quadrupled in just the last 3 years.
Quadrupled. Wow. And it seems like scooters, the two-wheelers, are really out front.
Yeah, they're leading the charge, definitely. In FY25, almost 13% of all scooter sales were electric. Compare that to just 3% back in FY22.
Okay, 3% to 13% in 3 years. What's making e-scooters suddenly so popular?
It's a few things coming together. One is affordability, especially when you factor in running costs. Electricity is much cheaper than petrol.
Makes sense for short city trips where range isn't a huge issue.
Exactly. And the total cost of owning one over its life is just much lower. Plus, the scooters themselves are getting better.
Features.
Yeah, companies like TVS, Bajaj, Ola, Author, Hero, they're putting in good range, smartphone integration, GPS, over-the-air updates. They're becoming quite techy.
Like a smartphone on wheels.
Sort of.
But
And when you look at China, Exhibit 4 shows their 2W EV penetration was around 35% in 2023.
Okay, so India at 13%.
Yep.
Still a long way to potentially go.
Huge runway for growth, yeah.
Okay.
And the story is similar for three-wheelers, the auto rickshaws. EV penetration there is already around 30%.
That makes sense, too. They often run fixed routes, right? Predictable distances.
Exactly. Fixed urban routes, high usage. The economics for electric just work really well there. Lower fuel, lower maintenance. Strong business case.
So 2Ws and 3Ws are flying. What about four-wheelers? Cars? Seems a bit slower, maybe.
It's picking up momentum. The foundations are being laid now. A big factor is battery costs.
Coming down.
Dramatically. Down about 60% in the last 7 years or so. That makes the upfront cost of an electric car much closer to a petrol or diesel one.
Okay, that's key. What else?
Charging infrastructure is growing fast. Went from maybe 1,800 stations in early 22 to over 25,000 by the end of 24. Still needs to grow more, but it's getting there.
And government help? Subsidies?
Yeah, government support is crucial. Schemes like PME Drive offer incentives. And again, that total cost of ownership, the TCO, is starting to look really good, especially for fleet operators who drive a lot.
Right. High mileage makes the fuel savings really count. And this isn't just personal transport, is it? Buses, too.
Yes, electric buses are a big part of transforming city transport. Governments, through state transport undertakings, STUs, are pushing for them.
Why? Just environmental reasons.
That's part of it, but also economics. An AC electric bus can have a 15–20% lower TCO than a diesel one over, say, 12 years.
Really?
No.
Even with a higher purchase price?
Yes, the fuel and maintenance savings are that significant. And there's this model called the gross cost contract model.
How does that work?
Basically, the STU pays a private operator a fixed rate per kilometer to run the buses. The operator owns and maintains the buses. It reduces the upfront cost and risk for the public transport authority.
Ah, clever. So it makes adopting e-buses easier financially.
Exactly. So you have falling battery prices. Exhibit 5 shows that trend, more local manufacturing coming online.
Right. The phase manufacturing program, PMP, encouraging local parts.
Yes, all boosted by government schemes like PME Drive supporting battery production and charging infrastructure. It's creating a whole ecosystem.
And the bottom line, shown in Exhibit 6, I think, is that across almost all vehicle types, scooters, autos, small cars, SUVs, buses, the total cost of owning an EV is becoming lower than owning an ICE vehicle.
That's the compelling long-term argument for the shift, yes.
Okay, powerful case for EVs. Let's pivot completely now. Lab-grown diamonds, LGDs. For anyone maybe not familiar, what exactly are we talking about?
Sure. So lab-grown diamonds are, well, diamonds. They're chemically, physically, and optically identical to diamonds dug out of the ground.
Identical, like same carbon structure, same hardness, same sparkle.
Exactly the same. Pure carbon, crystal lattice structure, the works. The only difference is where they came from. Natural diamonds formed over billions of years deep in the earth.
Right.
Whereas lab-grown diamonds are created in, well, a lab using technologies like CVD chemical vapor deposition or HPHT, high pressure, high temperature.
So CVD is like growing it layer by layer from gas, and HPHT mimics the Earth's pressure cooker.
That's a good way to think about it, yeah. The key thing is they are not simulants like cubic zirconia or moissanite. Those look similar, but are chemically different.
Got it. Real diamonds, just manufactured. So who's making these?
The big players right now are China, making maybe 45%. In India, around 35%.
Yeah.
Together, they dominate production. And India is actually the leading exporter of LGDs, about 29% of the global share.
Interesting. Now, Exhibit 7 compares them side by side. Origin, obviously different, production method, but the carbon footprint difference is huge.
Yeah, much lower for lab-grown, around 10 kilograms of CO2 equivalent per carat versus maybe 110 for natural. That's a significant factor for some buyers.
And the price. Wow. The example shows a 1 carat LGD solitaire at roughly a fifth of the price of a similar natural one.
That price difference is probably the biggest disruptor here. It's huge.
So how does this play out in the overall diamond market?
Well, global demand for cut and polished diamonds is around 34 million carats a year currently. Most of that is still natural diamonds.
But the supply situation is changing.
Exactly. The supply of natural diamonds is expected to be pretty flat going forward, but lab-grown diamond production, that's projected to grow fast, maybe 18% CAGR between 2023 and 2028. Exhibits 8 and 9 show this divergence.
And Exhibits 10 and 11 hammer home that price difference trend. LGD is getting relatively cheaper.
Right, making them much more affordable.
So apart from price, what are the other advantages of LGDs?
Well, the production process allows for more precision. You can potentially create specific sizes, cuts, qualities more predictably that helps retailers manage inventory.
Okay.
And it's easier to make fancy colored diamonds in a lab, pinks, blues, yellows, which are incredibly rare and expensive naturally. So it opens up design possibilities.
And just makes diamond jewelry accessible to more people, younger buyers maybe, or for everyday wear.
Absolutely. It sort of democratizes diamonds, like you said earlier.
Yeah.
It's not just for huge milestones anymore.
No, the newsletter mentions a specific company, IGI, International Gemological Institute. What's their role in all this?
They're a major player in diamond certification. Globally, they're the second largest independent lab for grading diamonds and jewelry.
And they certify lab-grown ones, too.
Yes, and crucially, they started doing it way back in 2005, so they had a first-mover advantage. They now have about a 65% global market share in certifying LGDs.
65%, that's dominant. And within India,
About 50% market share in India. They have labs and schools all over the world. And that certification is really important, right?
especially if they're identical physically, you need that independent verification of what it is and its quality.
Precisely. It builds consumer trust, which is vital. Exhibit 12 shows their overall market share growth and certification.
And Exhibit 13 mentions their business model. Asset light, good returns.
Yeah, apparently very strong operating leverage, network effects,
Yeah.
leading to really high returns on invested capital, over 85%. The barriers to entry are high in this business. It's all about trust and credibility built over decades. GIA and IGI really dominate.
And the outlook for certification itself looks good, especially for LGDs. Exhibit 14 suggests growth there.
Yeah, certification volume is expected to grow, maybe 5–10% CAGR overall. But the share of LGD certifications within that is projected to jump significantly, from about 13% now to maybe 27% by 2028. That's like a 25% CAGR for LGD certification.
Wow. Why the increase?
More consumer awareness, the shift towards organized retail and online D2C brands who rely heavily on certification, and maybe even certifying smaller stones than before. So yeah, IGI seems very well positioned for the LGD boom.
Okay, so we've looked at QC, EVs, LGDs.
Yeah.
3 really different examples of major disruption. Let's switch to the investor perspective. What does all this mean if you're looking to invest?
Well, it clearly presents big opportunities, but also significant risks, doesn't it? Navigating this kind of change requires a solid framework.
Okay, so what are the core principles for investors trying to handle disruption?
First, think long-term. Disruptions cause short-term noise, volatility. But focusing on the long-term potential helps you stick with the likely winners.
Right. Avoid knee-jerk reactions. What else?
Diversification. Don't bet everything on one disruptive theme or one sector. Spread investments across different themes, sectors, even geographies. It cushions the ride.
Makes sense. Don't put all your eggs in one disruptive basket.
Exactly. Third, stay informed and be adaptable. Things change fast. You need to keep up with tech trends, regulations, consumer shifts. Be ready to adjust.
Continuous learning, basically.
Pretty much. And finally, focus on quality and flexibility in the companies you invest in. Look for strong balance sheets, adaptable business models, and really capable leadership teams that can navigate change.
That ability to pivot seems crucial.
It really is.
The source also mentions Ambit Asset Management's approach here.
Yeah, they talk about finding companies that aren't just surviving disruption, but actually embracing it, using it to their advantage. Their coffee can portfolio, for example, focuses on those resilient businesses that have shown they can withstand shocks over time.
And their good and clean midcap looks for solid governance and smart capital use, qualities that probably help weather storms.
Exactly. Good governance, clean books, sensible capital allocation, these things matter even more during turbulent times. Similarly, there are other strategies.
Like emerging giants small cap targeting market leaders among smaller companies.
Right, looking for high growth, low debt small caps. Then there's the 10x portfolio aiming for mid and small caps with potential for massive earnings growth, riding India's overall growth story.
And micro marvels focusing on tiny companies with big growth potential and good governance.
Yet each strategy tries to capture different aspects of growth and resilience in this disruptive environment. The newsletter has performance details in exhibits 20 to 29.
So the big takeaway for investors is disruption is the norm now. It's not an exception.
That seems to be the message, yes. It's the defining force. Companies have to adapt and innovate or they risk getting left behind.
And the winners will be those that can actually leverage this change.
Precisely. That ability to embrace and harness disruption seems to be what separates the leaders and ensures long-term success these days.
Well, this has been really illuminating, a proper deep dive into these shifts. We covered quick commerce, its rapid rise, the improving economics.
Then the huge momentum behind EVs, driven by tech, policy, and sheer economics across all vehicle types.
And finally, the fascinating impact of lab-grown diamonds, really challenging the traditional market through price and accessibility.
And as you listen to this, it's worth thinking, what other industries feel like they're on the verge? Based on these trends, speed, technology, changing values, where might the next big disruption hit?
That's a great question to leave people with. How might these forces impact your own life, your job, your business?
Definitely food for thought.
If you want to dig deeper, we absolutely recommend checking out the source material. Look at those growth charts the companies mentioned, the tech details.
There's a lot more detail in there.
Indeed. Well, thank you for joining us on this deep dive.
We hope it's given you some valuable insights into this incredibly dynamic world of business disruption.